Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Josh Lipton alongside Alexander Canal. Live from our NYC headquarters, we're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
What happens now is that on the 19th, on Sunday, the ban goes into effect. What we expect is that app stores like Apple and Google will take the TikTok app off of their stores, that Oracle, TikTok's cloud service provider, will stop providing TikTok services. And TikTok itself has said that it will actually fully shut down operations in the United States, even though technically doesn't have to under the law.
2017, 2018, 2019, businesses didn't fully pass along costs. And that was during a time when China was growing amazingly stronger than the US. Tables have turned, actually, 2025. So I think that scenario is very helpful. I don't have a very negative view as we go into the Trump 2.0, because we have that case study with us to study how things happened with that.
With yields probably moving a little lower in the next couple of months, because we do think that particularly underlying inflation could actually go down a little bit in the first quarter, in particularly compared to where we were in the first quarter last year. That actually should be allowing for volatility to come down.
We've got 1 hour to go until the market close, and let's take a look where stocks are trading. And it seems like, Josh, we have a little bit of an everything rally. It's being driven the most by tech. The Nasdaq up about 1.6%. If we take a look under the hood at the Nasdaq 100, you'll see a lot of those big names like Nvidia, Alphabet, Amazon, Tesla, all moving into the green today. Not a lot of red on your screen. And to that point, if we take a look at the S&P 500 equal weighted index, that's underperforming the broad-based S&P 500. So that goes to show that a lot of concentration is within tech. Over a 5-day period, if we look at the benchmark S&P, we're looking to end the week with some gains across the board here, and that comes after that softer than expected CPI print on Wednesday. A lot of investors recalibrating their rate cut bets. It seems like the possibility of a hike has now been taken firmly off the table, and to that point, we saw some pretty drastic moves with the 10-year Treasury yield. If we take a look at a 9-day chart there, you'll see that steep decline on Wednesday. We dropped about 14 basis points, retreating from those 1-year highs. It was actually the largest intraday drop since August. We are now right around 4.6%, well off the 5% yield that some were fearing. We'll see if that can continue. And then finally, one other thing I want to call out is Bitcoin, another area of the market that's just having a massive rally today. We're trading near the high end of those 52-week ranges. We're almost at that record high of around $108,000 a coin, and it sets us up right into inauguration Monday, with the Trump administration really looking to make Bitcoin a priority under this new administration. So we'll see, potentially even more of a boon to come.
Again, right close to 108 again, right there. A few different themes. I think there's some individual names and stories. Allie, Intel, for example, which is just ripping higher today. We had this report that they could be an acquisition target. We're going to talk about that later. I think also, maybe these headlines we saw that Trump and Xi actually got some time together, had some discussions, talked about TikTok and trade and fentanyl. I wonder if that's helping sentiment a bit. Just, leaders of the two biggest economies on the planet talking to each other. And then finally, I just think bottom line this week, investors taking a breath, looking over the data, bank earnings, inflation, retail sales, and deciding, you know what, it's good enough for a bounce.
Yeah, we were a little wobbly, right, to start the year. So this was an encouraging week, and I think there is potentially more room to run here as we move forward.
All right.
Yeah, all right. Well, the Supreme Court has upheld a U.S. law that will ban TikTok on January 19th. For more on the latest, let's welcome in Yahoo Finance's Alexis Keenan. So Alexis, where do we stand here? It seems like there's been a lot of back and forth, and obviously Trump has been weighing in on this issue as well.
Yeah, so let's just flash back a few hours from just now. The Supreme Court holding that divest or ban law that is effectively banning TikTok on Sunday does not violate the First Amendment, not as to TikTok and not as to TikTok users. So the law of the land is TikTok must be banned as of Sunday, and the Supreme Court saying that the law is is safely on national security grounds. Now, President-elect Trump told CNN in a reaction that Congress has given him the decision so that he would be making the decision going into the future. In a post to Truth Social, he also reacted, saying that everyone must respect the Supreme Court's decision, but he said, my decision, calling it my decision, will come in the not too distant future, and that he just needed some time to review what has transpired today. Now, also, another reaction coming from TikTok CEO Shou Chew. Where else on TikTok? Here's what he had to say.
On behalf of everyone at TikTok and all our users across the country, I want to thank President Trump for his commitment to work with us to find a solution that keeps TikTok available in the United States. This is a strong stand for the First Amendment and against arbitrary censorship. As we've said, TikTok is a place where people can create communities, discover new interests, and express themselves, including over 7 million American businesses who earn a living and gain new customers using our platform.
So Shou Chew there kind of referencing some First Amendment protections that the Supreme Court just said that his company, that TikTok users don't have, nonetheless trying to balance it out here with Trump's comments. Whether he has the kind of influence that he's saying that he does and can affect for the app to try to save it, that's really unclear. The act does leave open it up to the president to decide when there has been a qualified divestiture of TikTok, guys.
And in terms of, Alexis, in terms of Biden in all this, Biden's basically saying, listen, my time's up. So this is officially, I'm handing this one to Trump.
Handing it off and also saying that the Biden administration does not intend to do any enforcement in that small window of time that the law would effectively be on the books.
All right, well, Alexis, I'm sure we're going to have you on a lot more to discuss the ups and downs. But for now, TikTok is sunsetting on Sunday. So we shall see.
So we think.
Go. So we think. We never know. It's always wild in Washington. But thank you so much for your insights. We're closing in on the final day of the Joe Biden era, and as Donald Trump gets set to retake office, he brings along some regulatory uncertainty. For more, let's bring in Scott Clemens, BBH Partners and Chief Investment Strategist. So Scott, there's a lot of unknowns here. What are you looking at as Trump 2.0 takes off on Monday? We really have this regime change in Washington.
I think it's safe to say that we're entering a new phase of deregulation, the shape and the scope of which is uncertain, because what's also uncertain is how much he can accomplish by executive order, and the answer is quite a lot, and how much he's going to need to rely on Congress to pass. Of course, there's a Republican majority in Congress, but it is razor thin, which gives a disproportionate voice to a handful of people who have other ideas. We've seen that play out before in the GOP caucus. I think we're going to see it play out again. But a year from now, 3 months from now, 6 months from now, certainly a more regulatory-friendly environment across a lot of industries.
Well, what about tariffs, Scott? The Journal's reporting today there was actually some friction in Trump world over that issue. There were some who were pounding the table, apparently, in that camp. Listen, let's go aggressive, let's go broad, let's go big. Others, they're saying, like Bessent, his pick to run Treasury, would prefer, why don't we get narrow, focused, targeted? How do you see all this playing out?
Some context for that is that tariffs have been a tool in a presidential toolkit going back to George Washington. His second act of office was an executive order levying tariffs on Great Britain to protect American trade. So it's a very common tool. He used it, Biden used it, everyone's used it. The scope with which he wants to use it, I think, is where the friction is coming from. If he steps in and proposes blanket tariffs as a matter of economic policy, I expect some members of Congress may raise a hand and say, Mr. President, I'm all on board with this, but I'd like for us to consider it as well. I think he'll end up getting his way. I mean, again, he has a majority in Congress, but we're moving into some untested territory with the use of tariffs as an economic incentive, as an economic carrot or stick.
I want to switch gears to the Fed. We did get some good news earlier this week, a slowdown in core prices, but many experts still saying that we're not out of the woods yet. So when you look out to the next year, how do you think the Fed balances the risk of potential bumpy inflation with also potential slowing growth depending on what policies Trump does choose to implement?
It's going to get harder. Right now, the Fed has the luxury of inflation coming down enough, albeit gradually, to allow them to think about lowering interest rates. And of course, they've acted on that already. But there's not enough economic stress yet to require them to lower interest rates. I think it's a fortuitous quirk of the calendar that after the Fed meets next week, at which they will make no change whatsoever, the next Fed meeting isn't until March 19th. So they've got 2 full months of more economic data, labor and inflation, most importantly, But they've also got 2 months of the new Trump administration to see to what degree these tariff proposals play out, immigration proposals play out. I think that March 19th meeting, which I've circled in red on my calendar, is probably the most important Fed meeting of the year. That's going to give us some indication as to how the Fed sees that balance of potential rising inflationary pressures, but also potential some economic storm clouds gathering.
Scott, we had another smart strategist on the show this week, been watching the markets a long time. He said, he did not think investors were paying enough attention to the possibility that actually the Fed does raise this year. That there is the risk of we see some just kind of another buildup in pressure of inflation, in part because of some of the fiscal policies that we've been talking about here. What's your take on that? Probabilities, as you see it, they actually would have to be forced to raise in 25.
There's no zero probabilities anywhere in finance. But right now, there's enough downward pressure, particularly in core inflation. And the two real engines of the sticky inflation and the core inflation numbers are, maybe surprisingly, auto insurance policies and shelter prices. And those two things have in common, they're very lagged and they're very slow to reset. Because if you've just gotten a new auto insurance policy, you don't get a new one next month. If you just signed a lease, you don't sign a new one next month. So there's enough downward pressure in that I think would prevent the Fed from needing to raise interest rates. There's always the possibility of some price shock out there. So what I'm looking for is if this administration gets very serious and aggressive, not only with immigration, but deportation, what I'm looking for is a potential upward rise in wage pressure. That is something that will get the Fed's attention because that's more endemic. Wage pressure tends to cause broad spread inflation. It's not just your coffee or your orange juice futures or something like that. Wages is what to watch most carefully.
And to that point, I was thinking about this too because it feels like inflation is going to remain at least hot over the short to medium term, especially when you think about some of those policies that you were just laying out. Does that mean the Fed can only really cut if there's major swings in the job market? Does that make it more important, the labor side of the story?
I think it does. And I think over the next few months, we're going to get enough evidence of weakening labor market that the Fed will have the ability to cut interest rates in response to that. I don't want to overstate that. That's just the labor market getting back to kind of a pre-pandemic level. And there, the thing to watch is not necessarily the headline unemployment rate, but deeper within that monthly report, the reasons for unemployment. What we're seeing over the past few months is that people losing their jobs is on the uptick. People leaving their jobs is on the downtick. So people are holding on to the jobs that they have. Firings are picking up a little bit. Those are incipient signs of economic stress. I don't want to overstate that, but that's the kind of thing that'll get the Fed's attention as we head further into 2025.
All right, last trading day of the Biden administration, Scott. This is it. Trump 2.0. Here we come. Thank you for your time.
You're welcome. Nice to see you.
And we are just getting started here on Market Domination. Coming up, Donald Trump promising a blizzard of activity on Inauguration Day next week. We'll tell you what to expect on the other side. Stick around, much more Market Domination still to come.
A new year for markets and leaders that power them is upon us. And that means the biggest names in business are about to descend once more to the ski town of Davos, Switzerland. That's where the World Economic Forum will be holding its annual meeting starting January 20th. Which coincides with the inauguration of Donald Trump as president. The biggest names in corporate America will lay out their visions and expectations for the new year on everything from navigating the Trump 2.0 economy to markets and AI. The theme of this year's event is collaboration for the intelligent age. And Yahoo Finance will be there on the ground as always, bringing you actionable interviews with top leaders from across industries. Will serve as your trusted guide to one of the most influential market-moving conferences of the year. So be sure to save January 20th on your calendar and tune into Yahoo Finance all week on our Streaming Now section on our homepage, our app, YouTube, DirecTV, and all major streaming platforms. We'll also be taping special episodes of My Opening Bid podcast, which you can find on all major podcast platforms.
Donald Trump and his allies are promising a blizzard of activity on January 20th, with a wave of executive orders to be signed within hours of his swearing in and more likely to follow in the days afterward. Joining us now is Yahoo Finance's Ben Werschel. And Ben, we're talking 100 executive orders here. So what are the priorities for this incoming administration?
For sure, yeah, Ali. It's a lot of big language we're hearing. Another one that you hear a lot from the Trump folks these days is shock and awe. They're really trying to go big here on day one. Sort of four areas, I think, to focus on in terms of the day one priorities. The first and most dramatic is a less directly financial topic, but it's the one you're going to hear probably the most from Trump, which is immigration. This could take the form of actions that happen on day one. It could happen what the team is calling a closing of the southern border. So that's going to be a lot of what you're going to hear. For investors, the number one thing to watch might be energy. There's a lot of energy actions lined up for Trump on day one. That includes things like reversing the LNG ban that President Biden imposed, possibly reversing some of the access that President Biden did earlier this week as part of as a kickoff of an overall deregulatory agenda for energy and a bunch of sectors. A third clear one that's emerged today is TikTok. That's clearly a top turn. And with the Biden administration saying they're going to delay enforcement and give it to Trump, that could be a big day one. The Trump team is weighing things like a 60 to 90 day delay to kind of give themselves more decision, but Trump has said he'll make a decision on it at some point in the future. And then the fourth clear one, I can't get out of any appearance with you guys without talking about tariffs. Trump has talked about a 25% tariff on Mexico and Canada on day one, on January 20th, signing that. Whether that he does that, whether it's, and sort of a lot of the details of that are still being worked out. There's a big debate within Trump world at the moment about exactly how to move forward on tariffs. It's going to go big. The question is, does it go big quickly, or does he sort of make it a more gradual approach to be more friendly to markets?
Ben, what about TikTok? Would you expect an EO, an executive order?
I think what Marco Rubio has sort of indicated on Trump's pick for next Secretary of State is that a 60 to 90 day ban or a 60 to 90 day delay on the ban is sort of top of mind for the team at the moment. So that's sort of, I think the gaming is that may be the first step here to kind of put off this issue for a couple months and then have Trump make a sort of formal decision at the end of that. But with it being sort of so sent of mind, maybe Trump makes up his mind and does something more permanent at the top. Either way, he's been very friendly to TikTok. So there's a lot of questions about whether he's gonna let this ban go forward in any form.
Great. Ben, thank you so much. Appreciate it.
Talk to you guys.
Well, for more on what the second Trump administration could accomplish in its first few days, joining us now is Tobin Marcus, Wolfe Research Head of U.S. Policy and Politics. Tobin, it's good to see you. So listen, Trump 2.0, it is here. Tobin, lay out what you think his priorities are going to be.
Yeah, so in terms of day one executive orders, I would largely agree with Ben in terms of those buckets. I think immigration certainly is going to be the place where they can do the most right away through executive order. Deregulation is something where they're going to send a very, very clear message right away. But outside of some of those big items like ending the LNG pause, like freezing regulatory processes that are underway, like the Basel III Endgame rules, the actual deregulatory process moves a lot slower in a lot of these cases. He can direct agencies to start working on unwinding regulations, but then they have to go through a generally multi-year process to unwind them, which is just as cumbersome as it is to promulgate them in the first place. So there, I think we'll see, big ambitions, somewhat clear end game, but slower movement. And then tariffs are a huge wild card. I personally am in the big but slow camp. I think they are probably not going to go through with the 25% Canada and Mexico tariffs in terms of, announcing and implementing those on day one with rapid applicability. But the signals have not been exactly reassuring either from Mar-a-Lago or from the Canadian and Mexican government. So lots of uncertainty there. And then looking farther down the road, the big legislative item is going to be this tax bill, which I think will stretch through much of the year. Huge questions there, both in terms of what the tax cuts themselves look like and in terms of how they're paid for, with some risks for sectors like healthcare and energy in terms of how they're offset.
And Tobin, TikTok, obviously the topic of the day. Trump has obviously flip-flopped on this. He said he's spoken to Xi Jinping. I'm curious how you think this decision will impact Trump's relationship with some of his closest allies, especially those in Congress, if he were to make moves to save this app.
Yeah, so I mean, the first thing that I would emphasize in terms of the decision-making around TikTok is that he doesn't actually have the authority to delay the ban based on the plain text of the statute. You know, he needs to certify to Congress not just that progress is being made, but that a legally binding set of agreements have been made towards executing a qualified divestiture within the 90-day extension that he's authorized to grant. So that's clearly not going to be the case. They seem determined to do some kind of delay anyway, but I think it is a temporary solution at best. I don't think he can indefinitely prevent this ban from coming into effect unless there actually is a divestiture. You know, so I think it kind of gets folded into the larger negotiation with China, where we have a ton of policy equities. There's his 60% tariff threats. There's his demand for action on fentanyl trafficking and precursors. There's this TikTok issue. You know, what we saw last time around and what I think we're seeing in terms of invitations both to TikTok and to Chinese officials to attend his inauguration is an openness to deal making. But I think that a deal is going to be elusive. I think it's going to be challenging to figure out a genuinely satisfying deal that offers enough to the U.S. that China is willing to give, that we don't have to go through with the tariffs he's threatened.
Tobin, I want to swing back on taxes, which I know you mentioned there, because I was speaking today to another policy analyst like yourself. He said something interesting to me, Tobin. He thought that Congress might actually feel the need to bump up the corporate rate in order to offset the extension of the individual tax cuts. What do you make of that?
I think that's extraordinarily unlikely. There's been some noise to that effect from various fiscal conservatives in the House, but I think it is very, very unlikely to happen. Trump certainly does not want that. He's proposed the opposite. He's talked multiple times about taking the corporate rate down to 15% in a targeted way for domestic production only. And Senate Republicans, I think, similarly have been fairly definitive that they're not interested in doing that. So I think there's a lot of pay-fors that are on the table. You know, I think Medicaid cuts are possible. IRA rollback is possible. Certainly, they'll go after things like the Biden student loan program. But I do not think that corporate rates are increasing.
I want to stick with taxes as well, because you mentioned how tariffs are a wild card potentially, but there have been multiple reports that even members of Trump's own party could vote to block that tax cut bill over, you know, different negotiations on the SALT cap reduction. So could that be a potential surprise, or are there other things that could surprise you down the line?
So it's certainly possible that that tax bill collapses. It's just, you know, you never want to fully bet against the possibility of congressional failure. And the margins are so razor thin for Republicans in the House in particular that getting anything done is going to be really challenging. My fairly strong base case, though, is that they will get it done. I think the cost of failure, both politically and economically, is very high. And so I think something will happen because something must happen for the most part in terms of what congressional Republicans will do. But it's going to be a really challenging negotiation. And sort of our bet, somewhat against consensus, has been that they will need to make some real tough choices and spending cuts in that package in order to get folks in the House on board. I think similarly, they'll have to placate the SALT caucus. They're not going to get everything they want for it, but they'll probably get some partial SALT relief at a minimum. But you know, it's not going to be the same kind of tax bill that we saw in Trump 1.0. We don't have another 14 points to cut the corporate rate. This is not going to be like rocket fuel for the stock market. It's going to be, I think, sort of sector by sector in terms of winners and losers.
You touched on something there, Tobin, which is interesting. You know, after the win by Trump, you know, investors thought, okay, pro-growth, pro-business administration, and it was that red sweep. And so I think a lot of investors, Tobin, in these kind of knee-jerk reaction, thought, okay, well, they're just going to be able to just ram through these pro-growth, pro-business policy items, taxes, regulation. But now, Tobin, you know, you just look at the last few weeks here and the drama around Speaker Johnson and the CR. All of a sudden, maybe it looks like it could be a little tougher to get through a lot of this legislative agenda. But I'm curious to get your thoughts on that.
I think that's absolutely right. We have never thought this is going to be a highly stimulative bill. You know, the net fiscal impulse will be positive in 2025. Some of these corporate tax changes, like reviving and extending 100% bonus depreciation and R&D expensing, you know, those will hit the economy before the potential offsets do. So, you know, on net, it will be slightly stimulative, but this is not the kind of thing where it's going to be either a huge macroeconomic tailwind or a huge earnings tailwind. Regulation, similarly, like it's clear where we're going. The overall direction of travel is clearly in a strongly deregulatory direction, but there's a lot of friction in terms of doing that. It's not going to be the kind of thing where you can kind of wave a wand and make all of these regulations on energy and so forth go away right away. So I do think it's more sector by sector. We've always thought financials are the clearest winner. That's you know, a sector where the regulatory relief is immediate when you look at something like Basel III Endgame being put on ice, something where the expected increase in deal activity is going to be a big a tailwind where the rate structure looks pretty good for them. But it's not the case that every single sector is going to get some huge infusion of kind of juice. Animal spirits are positive. Like, we'll see how long that keeps running. But I think it's a more mixed policy outlook.
Tobin, great to have you on the show today. Thanks as always for your time. Appreciate it.
My pleasure.
All right, time now for some of today's trending tickers, sponsored by Tasty Trade. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, Coinbase. That stock is up over 5% in today's trade. It's part of a larger trend of crypto-related stocks seeing bumps thanks to expected early action on cryptocurrency by Donald Trump when he's sworn in as president next week. So Trump does plan, Allie, to release executive order elevating crypto as a policy priority. This is per Bloomberg, citing sources. Orders expected to name crypto as a national imperative or a priority, also create a crypto advisory council, and under consideration, again, according to this report, the creation of a national Bitcoin stockpile. Trump, of course, campaigned as an ally of crypto. The crypto community rallied to him. See a nice pop, as you pointed out earlier.
Yeah, there's just so many reports about this. The Washington Post had a separate report that Trump plans to sign executive orders covering crypto debanking, accounting policies. Reuters saying at least one crypto exec order is expected on day one. And then you think about everything that's already transpired with Gary Gensler stepping down. Trump has nominated crypto-friendly lawyer Paul Atkins here. So it feels like the opportunity is there for Bitcoin holders. You can just take a look at the reaction today. We're pushing above $105,000 a coin, trading at the high end of the 52-week range, almost at the record highs that we saw. And since the election, Bitcoin has been a bit wobbly. We were below that $100,000 mark earlier in the year. We've seen some back and forth softness as investors have really debated this risk on versus risk off rally. But we are, steadily on the rise here. That started to happen when we got that inflation data on Wednesday. That's encouraging. And I just think these crypto-related names like a Coinbase, they're going to continue to see this boom as Bitcoin has risen as well.
Yeah, we've had plenty of crypto fans on the show since that win. They like the changes to the SEC, the deregulation, the strategic reserve. We'll see. All right, next up, let's look at another one here. Intel shares, they're surging after a report on a technology news site said the battered chip maker could be an acquisition target. The report says it read an email about a company trying to acquire Intel whole, and that the mystery company has the resources to pull it off. The mystery company, by the way, not named. So some unanswered questions here, Allie, but it was good enough to send this stock soaring higher. So we don't have a lot of details here. I mean, obviously this is a name that has been under a lot of pressure. CEO Pat Gelsinger last month, we talked about this getting pushed out. Stock's down around 50% over the past 12 months. Remember, Bloomberg did report Qualcomm that kind of kicked the tires on Intel, but then cooled off on that idea. I will say tech analyst Dan Newman, friend of the show, Dan knows Intel very well. He weighed in on X today on this, and here's what Dan Newman said. He said, I won't go as far to say there is no possibility that a bid for all of Intel has been made, but I will go as far as to say that the regulatory scrutiny of a deal like this leaves so few realistic suitors for the company. He stands by his assessment, which I think he told us as well, that a true split of the company, most likely outcome in his opinion.
Yeah, and I do agree with that point. I think no matter who the buyer is, it's going to be a difficult journey when you think about those antitrust concerns. Intel also has like $50 billion in debt. That makes any type of buyout particularly challenging. So it's a difficult transaction no matter how you slice it. Now, that being said, we do have this new administration. Maybe now is the time that a potential sale could be further explored. You mentioned Qualcomm has been rumored, Broadcom as well has been rumored as potential buyer here, but Intel, I mean, just a massive fall from grace from where it was. It used to be this dominant player. Now we have this very shifty competitive environment. We have names like Nvidia, AMD just overtaking some of that market share. So it's clear something needs to happen. I just don't know if that's going to happen this year and if that's going to be a full-blown buyout.
Now, with Trump and this new regulatory backdrop, too, I kind of agree with analysts and policy wonks who have told me they expect to see within tech, it could get friendlier for small cap tech consolidation. With large cap tech, they bet actually Trump is more closely aligned with Biden than a lot of people might be thinking.
And that'll be interesting too, to see how that sort of plays out.
And Trump often makes that distinction. As he says, big tech, little tech. Not such a fan of the former, likes the latter.
All right, yeah, it's going to be a very interesting year indeed. Our next trending ticker is Schlumberger, the oil services company, posting better than expected fourth quarter results, boosted by strength in its international business. The company's CEO saying on the earnings call, our 2024 results underscore the strength of Schlumberger's diverse portfolio to navigate evolving market dynamics. Now, on top of solid earnings, the company also raised its dividend payout by 3.6% and announced a $2.3 billion accelerated share repurchase program. Digging deeper into earnings, revenue rose 3.3% annually to $9.3 billion. Earnings per share were up 7% from the year ago period. Now, looking ahead to 2025, the company does expect flat revenue. They cited oil oversupply, so perhaps one slightly negative takeaway there from that report. But overall, investors seem to be pretty happy.
Yeah, and we care about SLB because it is the world's largest oil services provider. CEO had some interesting comments too, talking about oil supply imbalance, saying he's looking for that to abate. Talked about how rising energy demand from AI and data centers will support the investment outlook for the oil and gas industry throughout the rest of the decade. The stock has not done a whole lot. It's actually in the red over the past 2 months, though most of the street, they say you should buy it, Allie.
Yeah,
that's
interesting.
the recommendation. Coming up, shares of Novo. There we go. Novo Nordisk sinking. We got Anjali Kamlani, our ace reporter, coming up to give us the details. Medicare targeting 15 new drugs for price negotiations, including Ozempic and Wegovy. Yahoo Finance senior health reporter Anjali Kamlani is here with more. Anj.
Yeah, that's right. No surprise here. We know for a while that Ozempic and Wegovy were rumored to potentially be on the list based on a couple of factors. One, of course, the high price and the cost to Medicare to have patients on them, as well as the idea that the floodgates may be opening for more use of them based on the different diseases that they could be helping with. So no surprise there. Of course, we've seen Novo's stock take a little bit of a hit because of it. And it also does give competitor Lilly a little bit of an upper hand now, not just with the supply chain issues that they've been able to resolve, but also now without that pressure of pricing from the government. Take a look at some of the others that are on this list. We've got Pfizer once again with a drug, AstraZeneca once again, some of the players that are already out there having their drugs on. Merck's diabetes drug, Januvit, as well as Pfizer's Xtandi and Ibrance, which is its popular breast cancer drug, and it does bring in quite a bit of revenue. But something to note about some of these is that they are also, as you can see on your screen, of course, the cost to Medicare between November of 2023 and October 2024 can give you just an idea. Just to stay on the example of Ozempic and Wegovy, $14 billion in that time span. Meanwhile, within a 9-month period, they brought in about $50 billion for Novo Nordisk. But some of these drugs are set to go off patent. Ozempic and Wegovy, for example, the semaglutide drugs, looking at a potential end or patent cliff of 2032. Meanwhile, some of these others like Merck's and Pfizer's already on that list for by the end of the decade. So is it that much of a squeeze? We'll see.
Yeah.
Go ahead.
Well, and like you mentioned in your article too, Anjali, that it's unclear right now if the Trump administration will honor that list, if they will change it. So it's still some unknowns there.
Yes, and whether or not they will handle the negotiation process the same or differently. That's something that we're going to watch. How hard do they push? Do they stick with the back and forth situation, or do they give the pharma companies a little bit more leeway in how they process it? So we're all eyes on this whole process.
Have to have you back.
Yeah.
Always a lot to talk about. Anjali Kamlani, thank you so much. Appreciate it. Turning now to some calls of the day. First up, Salesforce upgraded at TD Cowen to buy from hold. The analyst also raising the price target from $380 a share to $400, saying, quote, following a strong end of 2024 rally on the heels of Agentforce excitement, shares have pulled back, creating a compelling entry point. So TD Cowen arguing a buy the dip move here for CRM, citing several growth drivers. We're down about 3% since the start of the year. A lot of interest in that AI application Agentforce. That seems to be the main motivator here in this upgrade. And from the research this team has done, they said that the perception of this product release is more market ready and carries more organic innovation compared to other releases. And this will create a halo effect around some of those other products. They lifted their full year earnings and free cash flow estimates as a result. So we'll see if Agentforce can get it done.
Lots of talk about AI agents, right? And basically what TD Cowen says, this is a smart way to play it. It's the AI agent play. They say with so much buzz around this AI 2.0 wave with agents, and with CRM taking the clear lead in mindshare, product innovation, monetization efforts, we think CRM is an attractive asset to own, to get exposure here. They also say reasonable valuation. Here's their takeaway. CRM is riding the AI 2.0 wave into this new era of software. Come on, if that doesn't get you excited.
The next AI hype train.
There you go. All right, we're also watching airlines. Bank of America out with a big no, downgrading Southwest and JetBlue to underperform from neutral, and that's because they have less exposure to the strongest industry trends, which includes corporate premium international travel. The firm also upgrading American Airlines to neutral. Let's start with the good news. They do upgrade American Airlines to neutral. They say should benefit from premium revenues, a build back of corporate travel. They talk about growth on Atlantic routes. They also note, Allie, it could realize outsized benefit from the return of corporate travel. Here's the bottom line to the clients. As such, we no longer believe an underperform rating is warranted and upgrade to neutral. They go to a full buy. Why is that? They say because they think the neutral balances the revenue potential with execution risk in our view. So they're going to go on basically a hold here. They do raise their price objective to 20, which is a big jump. They were at 12.
Yeah, the divergence of these various airline stocks stuck out to me. And I find the return of corporate travel also interesting. This is an area that has really struggled post-pandemic. We've seen a lot of return to office mandates since then. It feels like travel is back, at least on the corporate side. And I do wonder if leisure travel, if we could see a little bit of a pullback depending on what happens with inflation, what happens with some of these Trump policies. If we see further upticks, we did see airfares up pretty significantly month over month in December from that CPI print. So that's something that I'm watching. Also, how fuel prices can impact some of these airliners as well. So there's always potential risks. So just important to continue to keep track of throughout the course of the year.
You have a favorite airline or just whoever gets you the best deal?
I love JetBlue. I feel like they have the best snacks.
Yeah, that's a good reason.
I gotta say, I'm all about. It's all about the food for
That's
me,
a
Josh.
very good reason. That's a very good reason. I'll take it.
I'm a simple gal. Well, after taking a break Thursday, the tech rally is back on today with the Nasdaq up more than 300 points as Donald Trump returns to the White House. However, how long will the rally last? Joining us now is Kenny Pocari, Slate Stone Wealth Partner and Chief Market Strategist. So, Kenny, I want to start with this tech rebound, not so rebound. It's been pretty bumpy since the start of the year. Where do you see tech falling under a Trump 2.0 administration?
So I think it's going to be, first of all, thank you for having me. Nice to see you. I think it's going to be continue to be kind of a bumpy ride, right? The NASDAQ is still off about 2% from the highs after we started pull back almost 7.5% just a couple of days ago before we had this explosive rally this week. So look, tech is a sector you got to be in. I think tech will continue to do well under a Trump administration. It would have done well under a Biden administration or a Harris administration just because it is changing the world. So you have to be in it. I think you just have to be a little bit cautious. I wouldn't go chasing the names. I'd wait for opportunities on pullbacks to buy more tech.
Kenny, beyond just tech, interested to get your thoughts on the broader market here, because it's been interesting, Kenny. We had the big move off the election win, right? It's pro-growth, pro-business is back. Then we kind of falter, hawkish Fed. This week, though, Kenny, I mean, you looked at bank results, broadly solid. I think people looked at retail sales, inflation reports. They like what they see. We got this just sort of this zigzag continuing, Kenny. Do we continue doing that, at least until we get through earnings season?
I think we do. I think we do continue to zigzag. I like the way you described that because we're gonna keep getting this economic data that is either moderating or not, and that's gonna cause kind of the markets to become anxious or not as you go through. Look, I'm still in the camp that we're not getting a rate cut in 2025, right? I know the market is still pricing in a rate cut in late spring or early summer. I think that's very premature, right? Because I think the data continues to tell us that while the CPI maybe on Wednesday was okay, it came in line, the PPI the day before was actually hotter than expected. And as you know, PPI precedes the CPI because prices that the producers have to pay, if they're up, they're going to pass those higher prices on to the consumer, which reflects itself in a CPI 5 or 6 weeks later. So I'm continuing to be cautious on what the inflation data is going to tell us, which is why I think the market's going to continue to kind of remain in flux. Now, it's also going to be driven by bond yields. We saw the 10-year almost approach 4.8%. That's when the market had backed off. The S&P, the Nasdaq, they were off 7.5% on Monday morning. And then as we got that CPI report, and markets, we had that explosive rally. We've seen it rally right back as the buyer dippers went in. But I wouldn't be so quick just to be as aggressive. I'm a buyer of the market, absolutely. I'm a buyer on pullbacks, not on days like today. I'm doing absolutely nothing. I am not buying stock on a day like today. On days like Monday and Tuesday when it was weaker, we were absolutely in there buying names. But I buy it on down days, not up days.
Got it, Kenny. Now, speaking of the markets being a bit volatile right now, being in flux, we've talked a lot about this market breadth, right? The rally really extending beyond just big tech names. Do you see an opportunity for that, even if we do have this higher for longer environment?
100%. I see it in healthcare. I see it in the big banks, the financials, JP Morgan, Bank of America. Now, look, I own both of them and the firm owns them, but I've liked them all along. I've owned them for a long time, so they're just core names. But I think you have to look at the healthcare sector, too. Names like Merck is down 26%, or on Monday, Tuesday, it was down off 26% off the high. Johnson & Johnson, another mega cap name, they pay you 3 3/4% divvy to own it, and it was on sale down 25%. Those are the kinds of names. That's where you're going to see some value. And remember, healthcare was the underperformer in 2024. I think it was essentially flat on the year, while the S&P was up 25 or 26% on the year. So I think there's value in some of these big healthcare names. And besides that, financials, like I said, oil, I think energy is going to be a place to be as well.
All right, Kenny, thanks so much. Some great areas to look out for. And be sure to tune in to the debut episode of Trader Talk. That's Kenny's new podcast here at Yahoo Finance. Kenny sits down with portfolio manager Adam Johnson to discuss recent market pullbacks and predictions for 2025 interest rates. Take a look at this sneak peek.
So I am an investor, I'm not a trader. Right. You have to know what you're looking for.
100%.
And I always tell my clients, we focus on time in the markets, not timing the markets.
Right.
And so my approach is, if I can project out 2 or 3 years and look at the cash flow and see a pathway to, say, 15 to 25% earnings growth for each of the next several years, and I can put a forward PE, price to earnings multiple, on that future cash flow and arrive at a target that represents a double, maybe a triple over the next several years,
Right.
I'll buy it. And I don't worry about these pullbacks.
Right.
Netflix is reporting fourth quarter earnings on Tuesday. Live sporting events like the Mike Tyson-Jake Paul fight and 2 Christmas Day NFL games largely expected to boost the company's results, and investors are eagerly awaiting what the streamer has in store for 2025 and beyond. For more, we're bringing in John Blackledge, Managing Director and Senior Equity Research Analyst at TD Cowen. And John, you just heard me name some of those live events that we saw in the fourth quarter. How much do you think sports is going to drive not only the company's results, but really the long-term trajectory of Netflix?
Yeah, I mean, I think it'll be helpful. They're inching their way in, right? You called out the 2 NFL games. They did a 3-year deal with the NFL for 2 NFL games on Christmas Day. So that'll be helpful. And generally, live events is kind of the next leg of the stool, I think, for content for Netflix. And you had them start the year with kind of like sports entertainment with them launching WWE Monday Night Raw. And so we'll be looking for more live events and updates from the company there. And I actually think the Tyson fight and the NFL games capped off a really great year for the company, right? All in, revenue growth reaccelerated to mid-teens. We think they're going to add about 32 million members in 2024 to get to close to 300 million members. And you saw margins rise about 6%. So it was a great year. And as they get this live event strategy going.
John, the UFC is reportedly looking for $1 billion a year for its next media rights deal. John, I was talking to Joe Pompliano on the show this week, and Joe thinks that'll be split up among multiple partners, and he thought Netflix could be one of them. What do you think? Is that a possibility, John?
Yeah, I mean, I certainly. I think at this point they're looking at everything. I think people thought that they might get the NBA in-season tournament last year. They didn't actually do that, but I definitely think that they're looking at everything, and and there's a reason for that. They have this burgeoning ad tier where we're looking for them to end 2025 with about 48 million ad tier members across the 12 ad tier markets, up from 38 million in 2024. And we're looking for about $3.2 billion in advertising revenue for the company in 2025, up from 1.7 estimated in 2024. So yeah, I think we're just scratching the surface for their entry into kind of sports entertainment and sports rights, and not just in the U.S. but around the world.
John, it's been about 3 years since Netflix raised the price of its standard plan. Are we due for a price hike in 2025? And if so, how significant could those increases be?
Yeah, I mean, one thing that I thought was kind of bullish from an investor perspective is that Netflix raised price across all the tiers in Spain and Italy in the fourth quarter, including the advertising tier. So I do think, and in talking with investors the last couple of weeks as we head into the print next week, there is an expectation that they do raise price. And I think it would be across all the tiers, including the ad tier, which would be clearly beneficial, given that the entry point is so low across the different markets. But yeah, I think there is this kind of expectation that we'll get a price increase. And they had, aside from paid sharing, they had been doing pricing increases in the major markets like kind of every 12 to 18 months. They paused that a little bit with paid sharing, and I think they'll get back to that kind of cadence for price increase.
John, you look at the move the stock has made. I mean, we're up about 80%, John, over the past 12 months. It's just been a tremendous run. How does valuation look here?
Yeah, this has been discussed with investors the last couple of years, where it's trading at over 30 times earnings. And how we've kind of looked at it the last couple of years is like it's the global leader in streaming. They have revenue growth reaccelerating now, kind of mid-teens, margins expanding, free cash flow expanding significantly. And so we think it can hold multiples around here. And I would just say, so I think they hold, and as we get to 2026, you can apply that multiple to get kind of close to our price target. But I would also say that as we look at 2025, remember they got it to 11 to 13% revenue growth, and their biggest cost line item is content amortization, and we think that's going to grow kind of near where it grew in 2024, which is like mid to high single digits. So we actually think their margin guide is a bit conservative this year. So what could also help the stock, and I get that it's been a huge stock, like you said, up 80%, is there could be earnings upside as we get through the year with margin upside.
John, this will be the last quarter that Netflix reports subscriber numbers. With that going away, what do you think will be the most important metric to focus on?
Yeah, I mean, they're going to give us the revenue by the 4 regions. And I think they're going to try to help us out. And I'll give you an example. At 3Q earnings, when they gave the 11 to 13% guide, they said, hey, it's going to be driven in order by member growth, ARM, or average revenue per member, which we're not going to get either, and then by advertising. And so I think quarter in and quarter out, they're going to give us help as to, kind of what were the drivers across the regions. And, we've known about this for, a year or so, over a year. So I think investors are ready for it.
John, always good to see you. Always good to have you on the show. Thanks for joining us.
Thanks, guys. Appreciate it.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's trade, and let's see where the major averages ended up. The rally pretty much held up. We're off of the session highs, but still not doing too bad, right? The Nasdaq Composite finishing the day up nearly 1.5%. That was followed by the S&P 500 up 1%, and the Dow Jones up about 0.8%. For the S&P and the Dow, it was the best day since the election. For the Nasdaq Composite, Nasdaq 100, best day of 2025. Now on to Jared for a closer look at today's sector action. So Jared, not too bad of a day, right? A sea of green.
Sea of green for today. We got this acceleration yesterday off of CPI. Keep coming back to CPI because that was a big one. That less than expected print on the on excluding food and energy, that was a big deal. So let's check out the sector action for today. Then we'll go to the week. We only have healthcare and real estate in the red. Healthcare down by just a little over 0.5%, but it was a day of the mega caps. XLK, that's the tech sector, that was up 1.5%. XLY is consumer discretionary. Those two were outperforming. By the way, XLY up 1.4%. And then just after the S&P 500, so not quite outperforming, that is XLC, that's communication services. If we take a look at what happened for the week, you can see a sea of green here. Energy was the best performing sector. That's up 6.3%. We've seen crude oil surge to almost as high as $80 a barrel. So that's something we want to keep an eye on. Financials also doing well. We got all those big bank earnings this week, and now we're getting regional bank earnings into next week. Then we got materials and industrials, real estate, utilities, all of those on the top row up more than 4%. And if we take a look at the Nasdaq 100 for the week, look, Apple was down 3%, Meta was down 0.5%, but for the most part, we are seeing some big gains here. Tesla is up 8%, Amazon up 3%, Broadcom up almost 6%. And if we take a look at the leaders here over these 5 days, not a whole lot of red. XBI, that's biotech at the bottom, along with retail and another biotech, IBB ETF. Those three were the only in the red. What was the best performer this week? Guess what? It was Bitcoin. GBTC up 10%. Regional banks, I mentioned those before. Those were flying high, 8%. And then home builders up 8%. And a lot of this predicated on that big drop in the 10-year yield that we were seeing. I'm not going to get to the chart right now, but I'll just send it to you, Josh. We got a nice end to this week.
We sure do. Thank you, Jared. The Dow and the S&P 500 notching their first weekly gains of the year and their best week, by the way, since the presidential election in November. Well, joining us now to talk about all this is Linda Dissel, Federated Hermes Senior Equity Strategist. Linda, it's good to see you. So that was it, Linda, the last trading day of the Biden administration. Now we turn the page. Trump moves back into the White House. I have to imagine, Linda, you have plenty of clients asking you, what is that going to mean for them, for their portfolios? What are you telling them?
Well, good afternoon, and thank you very much for having me back on your program. It's going to be probably a more volatile year. That's what we're suggesting. We're bullish on the year, but there are so many possibilities for how the policies can work themselves out here with the new Trump administration. So we just want to keep our eye focused on the fact that inflation seems to be coming down apace and that the economy is still strong enough where we don't have to worry about a rise in unemployment. And if that's the case, we can be bullish that a soft landing was achieved. That's good for earnings, and we have a 7,000 target for year end.
Linda, we did see some much needed relief in the bond market this week following that encouraging inflation data on Wednesday. The 10-year trading just around 4.6%, but we've seen how quickly things can change, and there was a big concern that we could reach 5%. Do you think we see 5% yields at all this year? And if we do, what do you think is going to be the main drivers of that?
Well, insofar as we think that it could be a volatile year, we would not count out the opportunity to visit that 5% level again. And the stock market doesn't like the 5% level at all, and that does get people to worrying again. But if it's one thing we've seen is that the bond market has proven to be much more volatile in recent years than we might have expected it should be. It does not mean that we think that it will belong there or that inflation will resurge. We do not believe that. And so therefore, we pretty much have the 10-year bond yield coming down towards 4%, 4.5% by this year and 4% by next.
Who's been bossing the bond market around, Linda? Is that the bond vigilantes?
Yes, the bond vigilantes are very upset. I also think that it's just much more of a it's been a momentum. It was a momentum year last year. Lots of trading going on. I think like the volatility is something that the hedge funds really enjoy, and I don't see why the bond market can't also be participating in that. It just doesn't seem that we need to have that much of big moves. We have stalled out on inflation. Why should the bond market go back to 5%? I don't see a common sense reason why, but that doesn't mean we can't paint a picture sometime during these next months.
And Linda, one of the reasons why 5% has been a number that's been concerning is a lot of traders, they haven't been used to trading in such a high yield environment. So, is that just the reality that we're in now? Is it just this high yield factor?
Well, we're coming off of a very unusual, really 15 years where inflation was very, very low. Short-term interest rates for most of the 15 years were at 0%, and you only got 2% or so for putting your money in a 10-year government bond. That is what was abnormal. To the extent that you see Fed funds, we still think they go down, but they're not going back to zero. And they never were meant to be at zero for a long time. Say 3.5%, something like that for Fed funds, then that means that you should feel good and comfortable with a 4.5% 10-year bond yield. That's an upward sloping yield curve. You haven't had a curve this upward sloping in 5 years. That's the sign of a healthy economy.
Linda, earnings season kicked off this week. We heard from the banks. It's broadly solid. Linda, I'm just curious, what are your expectations for corporate profit growth this year?
Yeah, well, we're coming definitely off of a very strong year, particularly from the Mag 7, and just as was you were describing just before I got on, the Mag 7 and their strong earnings are not going to go away kicking. But what we have suggested would happen this year is that you will see an ever broadening in the participation of the rest of the market, what we call the forgotten 493. And honestly, they had been going up in fits and starts. We like small cap stocks, but they're not going to be happy until they're pretty sure that rates won't go up above 5% on the long end. To the extent that they can feel happy about that, the earnings look much better year over year as you progress through this year for smaller cap stocks. That will give us the broadening that should get us to that 7,000 S&P.
And speaking of the broadening outside of small caps, are there certain sectors that you're more bullish on than others?
Yes, indeed. We are bullish on the financial sector. Now, the financial sector, of course, is an early cycle play. It's also extremely inexpensive. Excuse me for a little bit of noise out there. It's also extremely inexpensive. Healthcare is inexpensive, and it is one that we look to for broadening. Industrials as well. You spoke about the energy patch and how strong it came out the year. It's not really supposed to get that far within the pace of just one like half of a month. So why not move over and take a look at those industrials? And utilities still remain really good. I mean, they're very much more of an AI play than they ever were before, and we still like those for overweights.
All right, Linda, lots of interesting sectors to watch throughout the course of the year. Thank you so much for your time.
Thank you very much, and take care.
It's the final edition of Bidenomics, and in focus this week, the economy that President Biden is handing over to President-elect Trump. Yahoo Finance senior columnist Rick Newman is here. So Rick, we made it, the final Bidenomics. What's the status? What is Biden leaving Trump?
Bidenomics is now Trumponomics. We'll be back with
the
that.
Return.
Yeah, that's right. Trumponomics is back. So Biden obviously is leaving Trump a good economy. Unemployment is low. We seem to have pulled off this soft landing from inflation, but there are some problems that Trump is going to have to grapple with. The prior guest was talking about one of them. It's those higher long-term interest rates. I mean, she was making the point that if we do end up with mortgage rates around 7% and 10-year treasuries around 4 to 4.5, that's a sign of a healthy economy. Guess what? Trump isn't going to buy that. He doesn't like those high interest rates, and we're going to see fireworks right off the bat if the Fed does not continue cutting short-term rates, which I think is sort of the base case at this point. Inflation, the battle against inflation is not over. We've actually seen the inflation rate ticking up during the last few months, so there could be more difficulty there. And of course, Trump's protectionism in deporting millions of migrant workers would actually be inflationary, so that's something to look at. Trump is going to have to grapple with the $36 trillion national debt, which is another factor that could be driving long-term interest rates up. And then in the longer term, I think Trump is going to have a very hard time getting GDP growth to 3%, which is where his incoming Treasury Secretary, Scott Bessent, says he wants to get it. There are just a lot of structural reasons that 3% is going to be very difficult. So we'll see what kind of economy Trump leaves his successor in 2028 or 2029. We just got a little bit of work to do.
Rick, I got to ask you, of course, about the big story of the day, TikTok, Rick. Get your thoughts on that. I mean, listen, there's 170 million Americans on this app. I understand. No politician wants to get on the wrong side of that. But how do you see this playing out, Rick?
Well, I mean, the great irony here is that there are several hundred politicians who are on the wrong side of this already, and those are the members of Congress who passed this law last year, and President Biden who signed it. Now, Biden couldn't care less. He's on his way out, obviously. What is Trump going to do? I think 6 months from now, I think somebody other than ByteDance is going to own TikTok. I mean, I want to remind everybody that the purpose of the law Congress passed last year was not to ban TikTok. The purpose was to get the Chinese owner to divest the company, to sell it to somebody else that is not based in what we call an adversarial nation, which is what China is. So that's the way to solve the problem. But of course, ByteDance, the parent, doesn't want to do that. They want to hold on to their crown jewels. But if it really comes to the fact that they have to sell it, there are a lot of people lined up to buy it. There's been talk about Elon Musk, but former Treasury Secretary Stephen Mnuchin, he's a Trump buddy. He wants to buy it. Kevin O'Leary, I think we've had him on. He wants to buy it. There are a lot of people who want to buy this company. So my prediction is they're just going to sell it. That's the way to solve it.
And actually, Rick, we have Kevin O'Leary coming up shortly. Thank you for the tease. Thank you, Rick.
Ask him what his highest offer is going to be. How high will he go?
Consider it done. Consider it done, Rick. Thank you. And you can scan the QR code below to catch Rick and the rest of the Capital Gains crew every Friday at 12 p.m. Eastern. And here is a clip from this week's episode.
How will we know when the debt crisis is here?
Fantastic question. I am increasingly concerned that we are getting close to that tipping point. The most frequent question I get is, what is the level? Right now we're at about 100% of GDP, meaning that debt held by the public is about the size of our economy. That's a very high level. It's almost unprecedented in US history, and we're headed much, much higher than that. When do we hit that point that it becomes a huge problem and we start seeing really dramatic market reactions? Is it 110%, 120%, 150%? We don't know. What I am fairly confident of is that we have passed the point where we could hit some type of major economic downturn or unforeseen event. Think of COVID, think of the Great Recession, others, that causes us to need a forceful federal response. And in that federal response, we may need to take into account what those bond vigilantes or what the markets are going to do as a reaction. That's not a strong position for us to be in as a country. When we have to determine our response to a crisis of the moment by what others are going to do in reaction to that, it means that our response is not being dictated by the fundamentals of the crisis itself. It's being dictated by the broader exogenous economic circumstances. And we don't want to find ourselves in that situation. That's why we need to get our arms around this problem sooner rather than later. To date, we've been the proverbial frog in the pot where the water is getting warmer and we think it's just feeling nice and cozy in there until it gets too hot where we start to burn. And I'm afraid that we're going to get to that point before we realize it. And only when we realize it are we going to have to start implementing really dramatic policies that are not in the best interests of our economy and our country moving forward.
The Department of Justice announced Friday it was suing pharmacy giant Walgreens for allegedly dispensing millions of unlawful prescriptions. The DOJ saying Walgreens from August 2012 until present day knowingly filled those prescriptions which lacked a legitimate medical purpose, were not valid, and or were not issued in the usual course of professional practice. The DOJ says this lawsuit seeks to hold Walgreens accountable for the many years that it failed to meet its obligations when dispensing dangerous opioids and other drugs. Put a number on this too. They say Walgreens, if found liable, could face civil penalties of up to $80,850 for each unlawful prescription filed.
Yeah, 300-page lawsuit filed Thursday in the U.S. District Court in Chicago. I'm taking a look at after-hours trade in Walgreens. We're seeing those shares escalate. Some of those losses were down about 3%. So certainly a story that is important, and we're going to have to keep watching and paying attention to. Well, with interest rate uncertainty as President-elect Donald Trump takes office and big banks beating expectations to start the earnings season, there are strategies for investors to play the options market. Brian Overby, senior options strategist at Options Play, joins us now to discuss more for Options 101, sponsored by Tasty Trade. So, Brian, you have two option trades for us. One focuses on Trump 2.0, which is the one that I want to start with. So, what do you recommend there on the options front?
All right. Well, I've heard many times today, a lot of people say, we don't know yet. And I think that that is the moral to the story heading into the inauguration on Monday. There's a lot of speculation on the tariffs that might be added. There's a lot of speculation on the new policies, on taxes, and how everything is going to play out. And also how the Fed is going to be handled going into 2025. So we've seen some of the interest rates increase with speculation on the Fed and what they're looking to do going into this year. And the small caps have been very complacent recently, trying to figure out exactly where they want to go. We always like to see the small caps leading the marketplace. But with all the potential news headlines, I should say, after we have the changing of the guard in the White House, I like to look at the Russell 2000 ETF, the IWM, and look at doing a long straddle. Very rarely do I look at that type of potential, but when you see the possibility of possibility of news headlines rocking the market. And I do think over the next month, we're going to have a lot of that. A long straddle likes the fact that there might be increased implied volatility. So for example, with the Russell 2000 index, when we were looking at that trade, it was at 225. You're going to go out and you're going to buy at the money call and an at the money put. So you're buying the 225 strike call and the 225 strike put. Now you're hoping that just the market goes somewhere, and you don't really care where, you just want it to go violently, so you want a big move. Right now, that trade, or based off of yesterday's closing price, was trading a little bit higher than $10. Right around, it was $10.78. So you're looking for about a $10 move in the Russell 2000 index, and it's made that move many times over the last couple of years. Actually, if we pull up a chart on the Russell 2000 index going back all the way back to 2022, you see a pretty large channel in the Russell 2000 index. And this was a time where I like to do a lot of straddles in that index, and that you'll notice that the range during that time period was from about the 162 level up to the 200 level. And that was it made that move quite a few times over a couple of year period. So if you're doing a long straddle, the biggest mistake that a lot of people will make is you want to make sure that the underlying stock can move as much as you pay for that long straddle. So if we're paying close to $11 on this trade, we want to see that type of movement in the IWM, and that chart actually displays that. So if you think that there's some potential news coming out after the inauguration, this is a speculative trade that you can do in the small caps, IWM in particular, the ETF that tracks them, going out a month in time after this big day on Monday.
And Brian, can you just define a little bit more simply the long straddle and what sort of that trade means within this environment?
Yes. Well, you have no regard for direction. That's the biggest thing. If you buy a call, you want the market to go up. And if you buy a put, you want the market to go down. So let's buy both of them, right? So the biggest danger here is that the market does nothing. We don't really know if any of the policies and the news headlines are going to be positive or negative for the small caps. But if we buy both the call and both the put, as long as we get a large move in one direction, it can pay us out. And we're going to go out at least, in this instance, we're going out 36 days, which is important because it gives time for a lot of the news events to play out.
So trade number one, the small caps. Trade number two, Charles Schwab. Brian, walk us through that trade.
Right. Okay. So this is a speculative trade. We've had some strong bank earnings kicked off by JP Morgan, Goldman Sachs, and also when they came out, these are a lot of the companies that are going to benefit from some deals being done in the investment banking space. But there also was mention about transactions. And if you look at Charles Schwab, which is a bank and also a brokerage firm and a registered investment advisors, and not to mention they have a plethora of funds, they're covering all gamuts in this space. And over the last month, we've seen a lot of analysts come in and raise their expectations on earnings about 2.5% over that time period. So I want to ride the momentum of the initial bank earnings. We had a couple that were kind of sketchy. Bank of America didn't do that well. But they're going to be announcing earnings on Tuesday morning before the open. So what we're going to do is a very simple trade in that we're going to buy an at-the-money call option and sell an out-of-the-money call option. So we're going to buy something that's only going to go out a couple weeks in time. It's 100% based off of earnings. And we're going to pay attention to what the long straddle is actually trading for, which is about $4.80. And once again, that's if I buy the put and I buy the call. That's the market expectation of the move after earnings. So if we're doing this trade, we have a real nice risk-reward situation in that we're paying $2 and we're hoping to make $3 on the upside. The maximum that it can trade for is $5. So we're going to buy the 75 strike put with about 14 days or 15 days remaining to expiration, I think. And then we're going to sell the 80 strike put. Now notice the stock went up about $1 today. When we initially put this trade on, it was right around 75.50. So we're within that 5-point movement. Now we just have to get our forecast right. So it's a speculative play trying to ride off the momentum in the financial stocks that have started with this earnings season.
Brian, thank you for your time, those trades. Appreciate it.
Thank you.
Time now for the watch next week. The markets will be closed Monday in observance of Martin Luther King Jr. Day, but President-elect Donald Trump will be sworn in for his second term on Monday at 12 p.m. Eastern Time. Be sure to tune in at 9:30 a.m. Eastern for Yahoo Finance's special coverage of the 2025 presidential inauguration.
And moving over to earnings, on Tuesday, Netflix is reporting results for the fourth quarter after the closing bell. It's been a busy quarter for the streaming juggernaut with live sporting events like the Mike Tyson-Jake Paul fight and 2 Christmas Day NFL games. Investors will be closely watching the foot traffic, the eyeball traffic, I should say, from those events, as well as what Netflix could have in store for price hikes.
And finally, we'll be keeping a close eye on TikTok. The U.S. Supreme Court upholding a federal law earlier today that effectively bans TikTok in the United States. The video sharing app has until Sunday to secure divestiture from Chinese ownership, or it will go dark in the U.S.
And that'll do it for today's Market Domination Overtime. Be sure to come back Tuesday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. We've got you covered for the next half hour with the latest and greatest market-moving stories, including a conversation with Kevin O'Leary as he continues his effort to buy and save TikTok. Stay tuned for that. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. Earlier today, the Supreme Court ruling that a ban on TikTok may take effect this weekend, rejecting an appeal from the popular app's owners that claimed the ban violated the First Amendment. Our next guest believes the High Court made the wrong decision, saying in a statement the court was all too willing to accept the government's say-so rather than demand hard evidence that TikTok poses a unique danger. A law signaling out and banning a particular speaker by name requires much more judicial scrutiny and skepticism than what the court gave it today. Joining me now is Thomas Berry, Cato Institute, Robert A. Levy Center for Constitutional Studies Director. Thomas, it is good to see you. So really a historic day, Thomas. The Supreme Court does give the okay to that TikTok ban. You think it was the wrong decision, Thomas? Lay out for us the reasons why.
Well, thanks for having me. I would say the number one reason why is that the law singled out a particular speaker by name. It didn't use any euphemisms. It said this rule applies to TikTok and only TikTok, and laid out pretty onerous restrictions on its corporate structure. And when a law does that, you have to have a lot of suspicion about what's the government's real motives here. A lot of what Congress said in the lead up to this law was they didn't like the speech on TikTok. They thought it was too pro-China or too anti-America. Whether that's true or not, the First Amendment doesn't allow the government to target a speaker or a company that speaks because of the viewpoint it expresses. Many Supreme Court precedents have said that in the past, but the Supreme Court in this decision, I think somewhat naively, accepted the government's argument that it singled out TikTok for reasons totally separate from the speech on that platform.
The speech argument is interesting to me. I mean, Thomas, and listen, I don't have my JD. I wish I did at a moment like this for a story like this, Thomas. But the speech argument is interesting because it seems to me Congress isn't suppressing speech. It's telling American TikTok users, listen, you can post the same content. You just need to post it on these other platforms. Take your pick. There's a lot. There's Alphabet, Meta, Snap. Those are just the big ones. We don't want you posting on a platform that is beholden to a foreign adversary. Or do I have that wrong in your opinion?
I would say that people have a right not just to post somewhere, but to post and collaborate with the platform they want to. So if the Supreme Court said that Jeff Bezos had to sell the Washington Post, or if the Supreme Court said the Washington Post has to just shut down, I don't think you could say that's no problem because you can just print your op-eds in the New York Times instead, or the Washington Times instead. Every newspaper has a particular editorial viewpoint and style, and every social media app has its own unique algorithm. People have much more success on TikTok than on any of the other competitors, as many of the plaintiffs in this case demonstrated in their legal documents. And I think once you start going down that road of allowing the government to pick certain speech platforms to shut down, it becomes pretty dangerous. And you run the risk of the government picking and choosing winners to try to tilt the free speech balance, tilt the marketplace of ideas.
But isn't ByteDance different than the Washington Post, Thomas? I mean, given its ownership and its location, I mean, isn't this what Congress and the White House decided? They deemed that actually this is a platform that is beholden to the PRC, the People's Republic of China, which they deemed a foreign adversary, right there with Russia, Iran, and North Korea.
My biggest issue with that is that if they really think that's such a compelling problem, why did they only single out one specific platform, one specific company? At oral argument at the Supreme Court, other companies like Shein and Temu were brought up that are also extremely popular in the United States, have exactly the same security risks, and yet the government didn't single those out by name. So I would say if the government has real concerns over data privacy and it's not just targeting TikTok for the speech on it, it should have passed a more generalized law. In fact, another portion of this same law had a general process for other companies to potentially have divestment forced if the government finds certain facts about it. That's a lot safer from the First Amendment point of view because that's a standardized rule that applies to everyone.
It's a big story, Thomas, and frankly, as we sit here discussing this on Friday afternoon, unclear what happens next. But thank you for your time, Thomas, and your insight. Appreciate it.
Absolutely. Thank you for having me.
From the latest CPI report to the start of earnings season, it's been an eventful week here at Yahoo Finance. Here's a look back at what you may have missed over the past few days.
So when you put it all together, it's a really good environment for investing in banks, and we've seen that in terms of the reporting results.
We feel there's a pretty durable
rebound underway here.
So I think you're going to see financials, even with these good results, continue to give it back simply because people are worried about the economy.
CPI headline number year over year rising 2.9%.
And it is undoubtedly good news. What it does is it trims the tail risks of a hike.
This still points us towards an easing cycle. We are making progress on inflation. It's just very slow.
We must use all the tools available to better serve the interest of working Americans.
So Scott Bessent has admirable goals, and if we reach them, it'll be terrific. I just don't think there's a very good chance we will reach those goals.
Scott Bessent's going to spend a lot of time managing fiscal policy and the communication of motivations and hope-for outcomes.
The Supreme Court earlier today upholding a federal law that will effectively ban TikTok in the United States on Sunday. That ban is potentially sending shockwaves throughout the creator economy. So we're bringing in two creators who have more than 6 million followers between them. Joining me now are TikTok creators Nadia Okamoto and Jose Monkey. Welcome to you both. Jose, I'll start with you. I'm just curious, Jose, walk me through how long you've been on TikTok and what has it meant, Jose? What has been the effect of being on that platform for you, for your brand?
Yeah, I've been on TikTok really since probably 2020, but my account really only started to get a large following, I'd say, in the last 2.5 years. And once that happened, I mean, that can change things for you very quickly. I had a lot of eyes on my content, a lot of people listening to what I was saying, more than I ever had in the past, and it gave me a much bigger platform to spread the message of data privacy and online safety. And that was really, a big deal to get such a big audience like that.
Nadia, I want to bring you in here as well. I am curious, Nadia, what does TikTok do different? In terms of that app, that platform, what makes it more valuable to you as a creator?
Absolutely. I mean, I think, not only as a creator, but also as a small business owner, TikTok has a unique ability to give so many more people the opportunity for organic virality. I think it's the nature of the app itself. Most users are coming on to consume content on the For You page. So primarily people that they don't already follow, maybe haven't actually connected with before, versus on an Instagram or a Facebook. Historically, those apps were ones that you came onto to look at content from people you've known for a long time or from a curated amount of people that you're following. And so what that does is it basically means that consumer behavior on the app is in constant brand discovery. So for myself as a content creator, I can come on. I came on in 2021 and had 2 million followers after 6 months. Without having spent any big money for paid ads or anything like that. My business started in 2021 as well, got onto the app, and through organic virality, we're able to grow really, really quickly, not only a direct-to-consumer business, but eventually land a national retail deal. And so I think that, uniquely, it's not just a difference in consumer behavior, but what it does is it allows emerging creators and emerging small businesses to have a better shot at gaining traction in the attention economy that we live in.
So Jose Monkey, Nadia just spelled out a lot of potential advantages, right? The future now of TikTok, unclear. It could get shut down, right? If it did get shut down, if it went dark, how do you react? How do you respond? Are you already making moves in anticipation of that?
Sure. Yeah, I think most creators are, right? I think that this is something that we've known was a possibility for a long period of time. Many of us have been trying to reach people in other places. I mean, I'm on YouTube, I'm on Instagram. So, I'm trying to let my followers know that they can find me in other places. It won't be the same, but it does give us a way to continue to reach people. But I won't, I won't sugarcoat it. It is definitely going to be a big reduction in the number of people I'm able to reach until I'm able to maybe rebuild that following.
Nadia, finally one to you here. Let's say TikTok does get sold, Nadia, to an American group of investors. How do you feel about that? Does that matter to you? Who owns it?
It absolutely does not matter to me. And I would say one of the really frustrating parts of navigating this ban is that it truly feels like we are a large constituency who are relying on elected officials to represent our interests, and they're doing the exact opposite of our interests and what we elected them to do. And if you look at the sentiment of users on the app, it is absolutely not in line with the decisions that are being made at a higher level. But I would say that the ownership of the app hasn't been a concern of mine. What I love about the app is not only how I can curate the content that I want to see, but also how I am able to reach people, as Jose said. And I think that, it's been very clear that if there were to be a sale in place, the algorithm wouldn't be necessarily an inherent part of that sale. And I think that's what is so special about TikTok as an app is the algorithm and is the global community itself. And I think that, if that might change, we've seen, how Twitter and the environment on Twitter changed when that changed ownership hands. And so it's not something that I would say I'm looking forward to, and it wouldn't absolutely be my first choice. It's not my decision, but all I can do is be out there and express what I hope, and what I hope for is that we can maintain the platform that so many millions of creators and businesses have been able to build on this app.
Jose Monkey, final one to you. There's a tech analyst, longtime tech analyst I know very well. He made a comment today. I thought it was interesting. I just want to get your take on it. He said, listen, the average TikTok user in the US is 24 years old. They do care about things like credit card hacks, for sure. They don't care as much about who sees their data. He described it as a post-privacy generation. That was just an interesting comment. I was wondering if you agreed with it.
I don't know if that's really true. I mean, I think that you'll hear a lot of people take this sort of devil-may-care attitude of making it seem as if they don't care about that sort of thing. I think they do care. So I think that people take it seriously, and I wouldn't take their sort of nonchalant approach to it as as them being naive. I think that a lot of my viewers, some of them fall into that age group, enjoy my content because it talks about the idea of keeping your data private, being safe on the internet. So I think that that's a message that really resonates, especially for a generation that is so online. So yeah, I think they're concerned about it. I just think that maybe, they're recognizing that sometimes, we need to make smart moves, and they're not sure if this one is the one that's the right thing to do here.
Jose Mungy, Nadia, thank you both so much for your time, for your insight today. We appreciate it.
Thank you.
Project Liberty has submitted what they're calling the people's bid for TikTok. It's a formal proposal to ByteDance to acquire TikTok's U.S. assets. Part of the Project Liberty team working to try and save the social media app is Kevin O'Leary, O'Leary Ventures chairman, and he joins me now. Kevin, it is great to see you. Big day, historic day. Supreme Court okays that TikTok shutdown. Kevin, first and foremost, your reaction, your response to that decision.
Well, I've read the opinion. I've also read the order from Congress. What's definitive today, which was rumored to be a possibility yesterday that won't be, is the idea of forking the code. In other words, can anybody buy it with the algorithm, get a copy of the algorithm, strip out the spyware, and operate it on an ongoing basis? The answer is no. The justices, in a 9-0 decision, that's what I call definitive, made it clear in the bottom of page 5 and 6 in their opinion. That's not going to happen. And so if you're going to buy it, whoever you are, and we're certainly interested in buying it, we've already submitted a formal bid. We've made it clear that we're not buying the algorithm, basically because we're not permitted to. And so now it's not really our decision at this point. These are the issues going through. We're waiting to see what Xi does in China, what he wants to do. Does he want to shut it down, or does he want to sell it, keep it open? What are the options? But it's getting more narrow, and the hours are going away pretty quickly.
Kevin, from what I understand, you actually went to Mar-a-Lago. You met with President-elect Trump. You made the case about why you're the guy to buy TikTok. What was the case, Kevin? What arguments did you make, and was he receptive?
He asked me, why should I care about TikTok? And I think it was a rhetorical question. He knows about TikTok. And I explained to him what I care about the most are the 6+ million entrepreneurs that make a living. You just had 2 of them on, that actually make a living and support their families with TikTok. Those are my people. Those are 2 generations of Shark Tankers, as I call them. They all know me. I'd like to think they trust me. And what was so important to me on this, and he understands this, is that I want to offer equity crowdfunding. They join me in the deal. Whatever price I'm getting it at, they get the same. And so I've got the first tranche worked out with the Jobs Act. This was complicated to do it. If you're interested and you want to learn more and express your interest in how much you want to invest, because the probability of something happening is getting greater every hour, just go to wonderfultiktok.com and have a look at it. And you decide what you want to do. But if you're on TikTok and you want to be my partner in it, look at that. I feel that's important because we have to create an environment where people feel safe about their data. And after all, what's holding back TikTok? It's a great platform. It's got 170 million. Why doesn't it have 220 million? Because so many people will not put it on their phone for concerns already detailed and now discussed and reviewed and decided on by the Supreme Court. And so if that's the case, let's fix it. And let's move on. I do not want to see this down for 1 second. That hurts my companies and millions of others.
Kevin, how much are you and your group willing to pay for TikTok? And if you do buy it, what exactly are you buying?
So we've put out an indication of what we think it's worth, around 20 billion. We've offered an LOI. The LOI is important because it gives either president the option, included in the order, the option to extend for 90 days while these 2 parties negotiate in good faith. And we hope that's the direction they're going to take, so it doesn't have to be taken down. What's most important is to add features that we know users want. And one of those, as you just heard it again from one of those creators, is I believe that I'm concerned about the privacy of my data. But if you control your own data, I'll give you an example. I'm a huge watch collector. I wear 2 watches. By the way, this is the new boyfriend from Chanel. There's only one of these in the world. Not that I want to get distracted, but it's the second time it's been on television. I just got it today. I love this kind of stuff. But anyways, the idea is that because I love watches that much, I want every piece of content watches have on TikTok. I want to see it. I want that information. I want the ads. I want the information from the brands because that's what I love. And so if I'm willing to give up my data to them and the platform is profiting from that, why can't I wet my beak? Why can't I get a little payback? I love that idea for my TikTokers and for my companies. I think we can incorporate that. We also think it would be great if it was interoperable. So if you're posting on X and you just click here to populate TikTok, we'll do that for you. You reach another 170 million people. Adding features keeps users happy, and we just have to listen to them as we go through the transition. But the best part is the equity crowdfunding. I think you're going to be a lot of interest in creators, and I'm happy to have them as my partners.
Kevin, let's say you buy TikTok. You now have this revamped American version, but you'd be going head to head with some big companies with smart engineers and some of the deepest pockets out there. I mean, Meta and Alphabet, Snap, and those are just the big players. What would be your competitive advantages in that space?
170 million users. That's my competitive advantage, but it gets better. When we solve this problem for parents and for companies and for the government, which will not use this product, when we solve it, we'll immediately increase our base, but it gets better. Frank and I are going to fly over to India and meet with Modi and say, listen, why don't we light up those 210 million users you turned off in 2020? Same with Switzerland, France, Germany, England, Canada. Why not create the world's largest television network that's based on freedom of speech and democracy? Who doesn't want to do that? That's really what Frank and I are doing here with Project Liberty. We've got a big plan here, and it starts with saving TikTok, but we don't stop there. We grow this much bigger, and we think we can. It's a fantastic idea, but it solves the basic problem. We failed users in America with all social media. They don't trust where their data goes. I don't care, not just TikTok, all of them. They're always wondering, where's my data? Where's my data? Who's got control of my data? Well, we're going to solve that.
ByteDance, how real do you think this threat is, that ByteDance turning off the lights, Kevin, and TikTok just goes dark? Do you think that's real, or do you think that's just a bluff?
No, I think it's real. That could happen. I don't know what's on Xi's mind, but my sense of that call, the same reporting you gave about Trump talking to Xi, there's a level of cooperation here. I think, frankly, if Xi turned off TikTok, it would really piss Trump off. That's what I think. And I don't think that's a good guy to piss off. That's my point.
Kevin, next time I'm wearing two watches. I can't be upstage like that. And I appreciate your time, sir. Thank you for joining us.
Take care.
Much more Ask for a Trend still to come. Well, for our chart of the day, we're looking at brand advertiser traffic on TikTok, and Yahoo Finance's Alexander Canal joins us now with a closer look. Allie.
That's right, Josh. With TikTok on track to shut down as early as Sunday, we've already seen advertisers move over to other platforms. That is our chart of the day. And according to new data released by e-commerce analytics platform MikMak, brand advertising on TikTok, it's down 21% so far this quarter compared to a 13% rise in Q4. Meta, which is the parent company of Instagram and Facebook, also down about 11%, while Alphabet's Google has been the biggest gainer so far, up just around 30%, followed by Pinterest with an increase of nearly 7%. Now, CFRA analyst Angelo Zeno said that even if TikTok is banned, which is a big if at this point, he does not see any major shifts in user engagement or ad-based spending for other social media companies. Earlier today, we did hear from President-elect Trump, who said the Supreme Court's decision to uphold the ban was, quote, expected, and said he would make a decision on the fate of TikTok in the not-so-distant future. So still a big TBD factor, but clearly if TikTok is shut down, it's going to have a lot of ripple effects for creators, for advertisers, and so much more.
All right, thank you, Allie. Appreciate it. And that is wrap on today's Ask for a Trend. Be sure to come back Monday at 9:30 a.m. Eastern for Yahoo Finance's special coverage of the 2025 presidential inauguration. Have a great weekend.